Hi, welcome to today's lecture on Chapter 8, the Efficient Market Hypothesis. So in this chapter, we're going to talk about the efficient market hypothesis, also known as the EMH. To start off, let's just mention random walk. So this is just the notion that stock prices change randomly. So the argument is that stock prices are going to go their own way, basically, so that the price changes are going to be random and unpredictable. So there's no proof of effectiveness in stock analysis because stocks are just going to be the consequence of market forces that we can't predict. So that's sort of the basis of this random walk. Now, when we talk about efficient markets, random walk is an extreme point of view that is very polarized, saying that stock prices change randomly, and there's not much we can do to predict it. Now, the efficient market hypothesis is a little bit different. So let's just talk about efficient markets for a minute. So, as an outside observer to the stock market, you might think it's more or less gambling. And in some aspects, some people treat it, the market, like gambling, some day traders and some very speculative traders. So they argue that movements in the stock prices have no real connection to what's happening in the economy or to the financial results produced by companies. So that's sort of what's behind the random walk. Now, in the eyes of people who hold this view, large swings in the market are going to be driven by emotions and like greed and fear rather than business fundamentals. And that, as we go through this chapter, we're going to try to make a connection between prices in the stock market and real business conditions. And we're going to ask whether and how the stock prices might be affected by human emotion. We'll dive more deep into how human emotion affects stock prices in the next chapter. But it's technical analysis and behavioral finance chapter. But in this chapter, we're going to start building a foundation of how to look at this. So, if we think of a company like Walmart, and if we look at Walmart from, say, the year 2000 to 2018, we're going to find, if we look at their chart, we're going to find two obvious patterns. First, Walmart revenues grow over time. So year after year, as revenues increase, and revenues are the sales of their products. So in April 2018, the company reported quarterly revenues of $123 billion, and that more than doubled the quarterly revenues that it had generated in early 2000. So perhaps an even more striking pattern is that there's clearly a one quarter each year in which the revenues peak. So if you're looking at the chart, those peaks occur in the first quarter, which ends for them on January 31st each year. So in other words, since the year 2000, Walmart has sold more goods in November and December and January than any other quarter, which is a very stable pattern. And this, of course, has to do with the holiday season. So when you think about this pattern a little, it should come as no surprise. Nearly every retail company in the United States sells more near the end of the year because of the Christmas season, holiday season, and of course Walmart is no exception to this. So if you plot the revenues and net income, you're going to see a very similar pattern over the years. So, of course, Walmart is a huge company, and it's with Amazon is the majority of the retail sales that occur. Now, because this company is so large and because much of the business focuses on necessities, Walmart's financial results are not terribly difficult to predict. They occur in a pretty predictable fashion. So this is another lesson we can look at when we're looking at companies and trying to see the pattern of their stock price into the pattern of the growth of sales and profits for a company. So if we look at the pattern of Walmart's revenues over a long period, of time, it can suggest that the forecasts for Walmart's future performance are likely to be fairly accurate because it's a predictable business growing at a predictable rate over the last even 50 years. So, is the stock market as predictable as Walmart's growth in revenues and profits? So, if you look at a stock price of Walmart at the end of each quarter from 2000 to 2018, you're going to see, much like the company's revenues, the stock price is higher in 2018 than in 2000. But it didn't follow a very smooth upward trend like the revenues did. So it's not a very predictable upward trend. The stock price is a lot more volatile. So the difference between the revenues and the stock price as far as change looks extremely random. So the ups and downs of the stock price don't have a high correlation to the actual revenues. So it's a sharp contrast for the more predictable movements of the revenues of the company compared to the stock price of the company. So it's not like revenues go up 10%, stock price goes up 10%. So there's no tendency for Walmart stock to peak at the same time that revenues peak for the year. So at the end of which is the end of first quarter. So this would suggest maybe there's no connection between the financial performance and the behavior of the stock price. But we know that there is some connection because overall the stock price is higher at the end of that 18-year period than at the beginning. It just took a more bumpier road to get there. So the correlation between the stock price and the movement of sales and profits, it does have a positive correlation, but it's not perfect. But basically there is no strong connection, I could say. And it may be helpful to think about what would happen if Walmart stock price moved in sync with the revenues exactly. Then, we'd see a seasonal peak of the stock price that year, but a lot of times that's not the case at all. So in some cases, you could have revenues going up and stock prices going down. And that's going to be because there's so many factors involved in the movement of a stock price besides revenues and profits. So let's just suppose over many years, Walmart stock displayed a regular, predictable tendency to shoot up every year in the fourth quarter along with sales. So if that pattern persisted, investors would come to expect the pattern to continue. So what would an investor do? Smart investors would buy the stock in the third quarter, and then when the stock would pop up in the fourth quarter, they would sell. So if investors rush to buy Walmart shares in the third quarter, of course that extra demand would put upward pressure on the stock price, and then in the third quarter, rather than the fourth quarter, the stock price would increase. So then investors would have to start buying in the second quarter if they want to get ahead of the third quarter increase. So in other words, the pattern of the fourth quarter peaks in the stock price would change to a pattern in the third quarter and then to the second quarter. So pretty soon investors would see the pattern and begin buying, sooner and sooner, and perhaps even the first quarter. So eventually the actions of investors trying to buy ahead of any peak in the potential sales price would cause seasonal patterns to disappear. So the lesson here is that if a company's financial results follow a highly predictable pattern, the stock price is not going to follow that same pattern year after year. In these are actions that investors tend to eliminate the patterns over time. So you can see how the stock price is going to be manipulated by the predictions of stock pickers. And everybody trying to get there first is usually why we see the stock market as a leading indicator of how a company is doing, how the economy is doing, before it actually happens. Because stock pickers are trying to predict the future with their purchases. You have to get in there before everybody else, before the stock price is higher, to make that money. So when we talk about this argument or the understanding of stock prices and company performance, it actually displays itself as more of a random behavior. So Walmart's stock price, does not imply that the stock market and Walmart's financial performances are unconnected. They certainly are connected. So remember that the stock price depends on investors' expectations about the future performance of the company. So prices move up when customers expect higher, brighter, stronger expectations for the company, and prices are going to move down when they think the company is going to do worse. So we see this with a lot of recessions. The stock prices will fall before the recession, and then the stock prices will increase before the recession's over because of this anticipation. So investors who bought Walmart stock back in 2000, were probably expected over the next 15 years the company's revenues would grow and that they would peak the fourth quarter of a year. But after all, after that long period, there's going to be, even though with the seasonal patterns, over a longer period of time, it's going to be a higher stock price. So that's why most financial advice is saying invest for the long term, because you ride out some of these peaks and valleys in the stock price. Don't be spooked by these upward or downwards aggressive trends in the stock price, because long term those should mitigate as long as the company's fundamentals are strong. So much of the actual performance in Walmart's stock price that went up significantly in this period would not surprise long-term investors. So what would cause a sudden and potential change in Walmart's stock price? Any sign that the firm's future financial performance would deviate from the current pattern. So suppose that Walmart is going to lose out more and more to Amazon, and Walmart can't make a strong online presence, and the traffic to their physical traffic to the store starting to have a declining pattern. This would definitely be a detrimental effect on their stock. So the main point here is that stock prices respond to new information. So new information is something that people do not already know and can't anticipate. So when new information comes out, a surprise information or something they didn't expect, that's when stock prices can move suddenly. So, we know that Walmart's revenue is going to peak at the end of each year, so this is not new information. So when they do occur, the peak occurs, it does not tend to boost the stock market performance at all. So if there was some sort of surprise in earnings, then we would see a bigger response as the Walmart stock price. So for the most part, this new information is unpredictable. So stock price movements thereby are also largely unpredictable because new information is coming up all the time. So this is sort of what's behind this random walk hypothesis, which is going to predict stock prices moving in different directions. It's going to be very difficult to predict this, if not impossible. So the random walk is going to be, very strict hypothesis that stock prices move at random, and it's not a sign of that the stock market is predictable. So there's an unpredictability to it, and that the random walk would suggest there's no connection between the stock market and real business. So the seemingly random behavior of the stock market is a sign that the stock market is processing information quickly and efficiently. So this underpinnings of this random walk that I've been trying to explain later was the basis of forming into the efficient market hypothesis, where prices of securities are fully reflected in the information. So that means that economists, they're going to say a market that is rapidly and fully incorporating all the new information is going to be a more efficient market. And that makes sense. So, news comes out. How long does it take the stock market to that be reflected in the stock market? And most of the times it's instantaneously. Okay, so let's just advance the slide here. All right. Actually, let me go back. I want to say a few more things about the efficient market hypothesis before we move on to some of those graphs. So the efficient market hypothesis, this again is the notion that stock prices rapidly incorporate any new information into the prices of stocks. So let's see. So this idea is, sometimes difficult for investors to comprehend. That's why I'm going to spend some time talking about it today. Even professional investors who may have earned abnormally high returns by identifying undervalued stocks, buying them, identifying overvalued stocks and selling them. So spotting bargains in the market, it's difficult if the market is indeed efficient. So if the market is truly 100% efficient, you shouldn't be able to find overpriced or underpriced stocks. So by the time you have process the information, which leads to you to believe a stock is a good buy or bad buy, the market the market itself. Think of the market as a living being with all of these people like cells inside of it making buy and sell orders. Should incorporate that information, and the information should be reflected in the stock price pretty quickly. So the EMH is going to say that investors should not expect to earn abnormal returns consistently. Like those are flukes. What constitutes abnormal returns? Previously you learned that there is a positive relationship between risk and return. Investors that tend to earn higher returns also tend to take riskier actions. So therefore, an investor's expected return is directly related to the risk. So the abnormal return, which we also know it as alpha, is the difference between an investor's actual returns and their expected returns. Okay, so let's look at some of these other slides here. So let me advance the slide here. So let's take a moment to look at this slide. Okay, this chart, which we call figure 8.1, illustrates the response of stock prices to new information in an efficient market. So the graph plots the cumulative firm-specific returns of a sample of companies that were targets for takeover attempts. In most takeovers, the acquiring firm pays a lot more than the current stock price, which we call a premium. And that an announcement of a takeover should cause the stock price to move up significantly. So this figure shows that stock prices jump dramatically on the day the news becomes public. However, there is no further drift in prices after the announcement date, suggesting that prices reflect the new information, including the likely magnitude of the takeover. So if we see here, here's the days relative to the announcements. So here we see sort of an uptick in the stock price and then a huge jump. So this is the official announcement of the takeover. So back here, the stock price really shouldn't have this run up here unless there was some sort of speculation or news about a potential takeover happening. Once the takeover is officially announced, the stock price jumps up and remains sort of stable. So this is abnormal returns and related to a takeover. Let's move to the next slide here. Okay, so this is what we call figure 8.2, stock price reaction to CNBC reports. So in this figure, we're going to look at the CNBC midday or morning segments, which is CNBC is a stock-related, markets-related news show that may or may not be on every cable station package. But in this figure 8.2 is the time in which a stock is mentioned at the midday. So at the top line is the average price moving of stocks that receive positive reports. So this is the top line with the diamonds. And these triangles is going to report the returns on stocks with negative reports. So notice that the top line levels off, indicating the market is fully digested the news within 5 minutes of the report, and the bottom line levels off within 12 minutes. So this is, again, just looking at, once news is issued, we're going to have a digestion of the news, buying and selling, trading occurring, and then the leveling off of the volatility. So thereby showing that new information is efficiently incorporated into the market. So competition is going to be the source of this efficiency. So think of all these individual investors who are buying and selling based on news that comes out on the stock. So this should imply that stock prices are going to reflect that information, and investors are going to exploit available profit opportunities when they figure out news is released that a company has a new product or has a new advantage, and this competitive advantage can verge on insider trading if somebody knows something before the public is made aware. But the idea is information comes out, the market correctly digests it, thinks about its impact on the stock price, and trades move to reflect that into the stock price. We'll see in the next chapter how people are not logical computers, so there could be emotional over or under reaction to news that can create an anomaly in the market. But the efficient market hypothesis is going to stay something a little bit different. So we have what we call three versions or three forms of the EMH. So I'm going to talk about each of those forms with you. And you see these, look at these circles down here. So the weak form is going to encompass a smaller universe, and the semi-strong is going to encompass a bigger set, and then the strong form will encompass everything as far as the effects. So let me just kind of talk more about, let's start with the weak form. So the weak form, holds that stock prices fully reflect any relevant information that can be obtained from an analysis of past price movements. So basically, if we look at what we're saying here is sort of looking at charts or momentum or technical analysis, basically, is what it's saying. So it's saying that the stocks will fully reflect any relevant information that can be obtained from the analysis of price movements. And they're talking about the movement of stock prices. So it's basically saying that technical analysis will not work to help you pick out a stock price or pick out a stock that's underpriced. So if investors study the historical records of stock prices and spot some kind of pattern to repeat, their attempts to exploit that pattern through trading will cause that pattern to disappear over time. So we've already discussed this idea to explain why patterns appear. When we talked about Walmart stock before, Walmart stock price does not exhibit predictable patterns, and we talked about how that disappears as investors start anticipating and trading based on this knowledge of patterns. So even though Walmart's revenues show distinct seasonal peaks, in short, the weak form of the EMH says that past data on stock prices are of no use in predicting future price changes. According to this hypothesis, prices follow what we talked about earlier as a random walk. So the weak form is sort of, all these forms of efficient market hypothesis come out of this random walk idea that we mentioned earlier. So what we basically mean here is that tomorrow's price changes are unrelated to today's or yesterday's prices. And this is basically what weak form is saying, is that technical analysis, which we're going to learn about next chapter, does not work. Now, the research on this weak form of the market efficiency appears to confirm that predictions of price movements are random. So using databases, charts to contain past prices and their movements of stock research is not going to open up any good buying opportunities for you. So this is the theory that has had the most support, the weak form, saying that technical analysis or price behavior is not going to produce future results. So what this is basically saying is that, yes, technical analysis looking at trying to predict future prices based on past price movements doesn't work. But it would kind of state that studying the financials of a company and the financial patterns should work, and having any type of inside information about the company or any information about the company that isn't public should also work to help to make you a profit. or find stocks that are undervalued and invest in them. So let's move now to the semi-strong form. Okay. So the semi-strong form, these are sort of like levels up. So that's what these circles here are kind of showing. It gets more intense and more inclusive of everything. So by the time we get to the strong form, it's going to basically say nothing's going to help you. But the semi-strong form is going to say that stock prices fully reflect all relevant information an investor can obtain through public sources. So when they say all relevant information, what they mean is it's going to contain, the stock price is going to contain all information about past price movements and all financial information about the company that's public. So everything that's known about the company should already be have already impacted the stock, and the stock price is trading at exactly where it should trade based on all this public information. So that means investors can consistently earn abnormal returns by using publicly available information such as annual reports, other required filings, analyst recommendations, product reviews. So it just, none of this information is going to help you because it's already been known and factored into the stock price. So suppose that you see a particular firm that has just posted its latest financial information online. You read the report, you see that the company reported unexpected surge in profits in the most recent quarter. Should you call your broker and buy some shares based on this news? The semi-strong form of the EMH is going to say, by the time you download the annual report, read it, call your broker, the market price is already reflected in has increased before you have time to act. And you'll see, if you do follow this and you see a company releases earnings reports or releases any news, by the time you read the news article and look at the stock price, it's already been reflected. So the things can move, the market moves much faster than any one person can move. Your eyes just can't digest the information faster than the market's going to incorporate it into the stock price. Now, as far as research testing this form, the researchers have gathered data, large numbers of earnings announcements from different companies. They tracked the company's stock price behavior before and after the announcements, and the common factor in all the announcements was that the companies that were reporting good news, that their earnings were higher than analysts had experienced. And so in a sense, the question that the researchers were asking was, is it smart to buy a stock of a company that announces, this kind of good news? So, we could see that there is a pattern here. So, that you'll see a reaction to a company who beats the stock analyst's revenues and profits is going to have usually an increase in the stock price. So, many firms are going to release their financial information when the market's closed to prevent, to reduce insider trading and reduce the unfairness of it being released during the market hours. So it means that, you have an opportunity to read the report, think about it, and make your trades the day after the announcement is made. So that's why generally we see the change in the stock price the day after the announcement is made. But some companies release before the market opens as well. So the behavior of prices is pretty close to this, strong form that would say that, the stock isn't going to react until the information is known, and as soon as it's known, it's going to be inside of the stock price. So this past public information isn't going to help you because it gets into the stock price before you have a chance to really even trade on it. So, most of the tests of the semi-strong, how effective it is, examine the stock price's behaviors and the particulars of, how news is released. And some companies show stronger relationship to this efficient markets, and some companies don't. So some of the research is supportive, some of it's not supportive. But in most cases, the market initial reaction occurs within minutes of the news being released. So these numerous studies have examined the investment performance of professional investors, such as mutual fund managers. Some people have argued that although the stock market may be efficient enough to prevent individual investors from earning abnormal returns, surely professional investors who have advanced training and degrees in investments and who spend their entire professional lives thinking about investments can perform better. But the conclusions from this research in this area are not unanimous in one way or the other. But most studies find that even professional investors struggle to earn abnormal returns on a consistent basis. And this could be one of the reasons why mutual fund managers fail to beat the market more times than not. So, since the mutual fund managers don't earn returns, that are going to beat the market consistently, it kind of supports this idea, this theory. So in other words, fund managers who have above average returns one year did not have, a very likely chance of getting above average returns the next year. So the overwhelming evidence indicates that stock prices react very rapidly to any important new information, which makes it very hard for investors to beat the market unless you hear about this news before it happens. So that would be the only thing that would make the semi-strong form. The only way to make money if the semi-strong form of the EMH is true is saying all known information is already reflected in the stock price. So the only thing that can move the stock price is inside information or information you have that the general public does not know about yet. So say you're an officer of the company and you know that the company is going to purchase another company or the company is going to be taken over and you just close the deal, no one else knows about it except the 12 people in the room. That would give you an advantage if you traded the stock. And that's why we have laws preventing people on the inside of the company from trading stock. And that's what we call insider trading. So the semi-strong form says, basically saying technical analysis and fundamental analysis do not work. Only insider trading works to make abnormal returns. And we're going to learn about fundamental analysis in a later chapter in this book, and technical analysis next chapter. So the third and last form here is the strong form. And what we're going to say here is that prices reflect all the relevant information, including inside information. So if that's the case, that means nothing is going to help you to make abnormal returns above the market averages. So the strong form holds that the stock market can rapidly incorporate new information, even if it's not fully public information. So even inside information is going to be efficiently incorporated into the stock price. So the stock prices rapidly adjust to any information, public or private. So one type of private information is the kind obtained by corporation insiders that we talked about, officers and directors, people directly, making decisions in the company. So they have access to all this valuable information about major decisions the company is going to make. They also have detailed information about the financial state of the firm that may not be available to shareholders. Insiders are generally prohibited from making these trades prior to these major releases. So, however, other times corporate insiders may illegally trade shares of stock in their company. If they report the transactions to the SEC, so this could lead to a problem. So sometimes executives may tell a close friend or family member, but the SEC isn't stupid. They usually make those connections, look into that. But if you are an insider of this company, you're going to have to file forms to the SEC that are going to that you're going to indicate when you're going to buy and sell the stock, and the SEC will make that information public. So the information will know insiders' plan to buy or sell the stock. So corporate offices, VP, vice presidents and presidents and CEOs and CFOs can buy and sell company stock. They just have to register and let the SEC know ahead of time if they're planning to buy and sell the stock. And then the SEC will let the public know. If they try to buy and sell the stock without notifying the SEC beforehand, they can get in trouble. But the strong market is going to say that this is not going to help. Even if you have this inside information, it's already going to be priced into the stock price. So this is the form the least amount of people believe in, because there's so many examples where inside information would have been helpful. Although there are still examples where you had inside information of something happening and the stock did the opposite. And there have been occasions where, good earnings are announced, the stock price goes down. Bad earnings are announced, the stock price goes up. The company's going to do a takeover or be taken over, and the stock price goes down. And so there are, sometimes even with the inside information, it's not going to help you perform the way you think it will. Now, technical analysis is something that we're going to talk about more significantly next chapter than this chapter, but we're still going to touch upon it. So technical analysis is going to be research on recurring and predictable price patterns, and that's going to help you to understand how to buy and sell a stock. So when you use technical analysis, you're not looking at the financials. You're not even looking at the business of the company. You're just looking at the stock price charts and the stock price data. And certain patterns can occur in the chart or in the stock price data that will be giving a buy or sell signal. So resistance level is a level which the stock is unlikely to penetrate and move above. And a support level is where a point in the stock price is unlikely to fall below. So stocks sort of operate in what you could think of as what can be described as a snake in a tunnel. And they sort of have an upward and a lower boundary. So say that the resistance level is 100, the support level is 80. So stocks for a long period of time can be traveling between $80 and $100. It reaches 80, turns around, goes up to 100, reaches 100, turns around, goes back down to 80. So in technical terms, if you see this pattern occurring, you know to buy the stock when it touches 80, sell it when it touches 100. But there are other technical layers as far as what happens if a stock breaks any of the support or resistance levels. Well, typically, if a stock breaks a resistance level, technical analysis say that that's a breakout in the upward trend, showing momentum, and you should buy the stock. If the stock price penetrates the support level, that's a breakout below the support level, and the momentum trading would say the stock price is going to continue to go lower. So technical analysis is a very interesting area. Although a lot of academics don't like it, there are a lot of traders who make a lot of money using it. So a lot of hedge funds, and there's a hedge fund run by a guy named Jim Simons called, I think it's called Renaissance, I think. He first started out, this is a very well documented, published, recognized mathematician. So he started a small hedge fund company in the beginning using fundamental analysis. When that proved unsuccessful, he moved to technical analysis, utilizing computer and mathematical power and properties and principles, and was able to make abnormally higher returns in the market for a long string of consecutive years. So even though it's hard to research and prove technical analysis, the results of it, people who use it, are sometimes undeniable. Okay, so fundamental analysis is utilizing the company's financial data. So you're going to try to determine the stock price based on earnings, sales, dividends, news, financial news related to the stock. So a fundamental analysis is going to look at stock value related to the actual performance of the company's financials. So a fundamental analysis, including a ratio analysis, is something that a lot of mutual fund managers work with, a lot of individual investors work with. And then we would look at the stock price should be equal to some amount of discounted cash flows from the future. So both technical analysis and fundamental analysis are two chapters that we're going to cover in this video series. And these are two important aspects for the final exam in this course, which is going to highly center around your ability to utilize and interpret technical indicators and fundamental indicators. And this leads us to active versus passive portfolio management. So active, of course, is going to be a type of management strategy where you're actively picking and selling individual stocks. So you're doing the research, whether it's technical or fundamental. You're finding stocks you like. You're including them in your portfolio. So you're spending a huge amount of energy to research, collect data, buy and sell and trade stocks to actively manage the market to make a better return. Now, a passive investment strategy is just buying a well-diversified portfolio and not really attempting to find anything that's mispriced, overpriced, underpriced, just saying, I like these 30 stocks, they're pretty well diversified, and putting them into a portfolio and holding them for a long time. And an index fund pretty much does that for you. So a lot of mutual funds will have an index fund that's going to represent, the mutual fund is going to represent the same stocks in the index fund. Now, over time, which has performed better? Some years active trading portfolios perform better than passive portfolios, but more often than not, the passive portfolios perform better than the active portfolios. And so that would say that, the market, if you put your money into a passive portfolio, then the market is already made sure those prices are correct. So you're not overpaying for anything. So your returns should be fine, is what is the implication of the EMH. So now let's look at the portfolio management. And if the market is efficient, how does it affect portfolio management? So active management has to assume that the market's inefficient in order for to be active. There's no reason to be active if everything's correctly priced. So the active manager is going to be on the hunt for stocks at a discount, stocks at a bargain. Where the passive management is, more consistent with the semi-strong hypothesis. So inefficient market pricing leads to inefficient resource allocation, is what we could say a result of this implication of this EMH. So, so the magnitude issue, we would say that the efficiency is relative, coming in relative waves of more significant, less significant. It's not binary. It's not 1 or 0. It's not yes or no. Now, there could be what we call a bias issue or a selection bias issue, where investors who find successful investment schemes are less inclined to share the findings. So the bias is that you get predisposed to one methodology that you think works, and you're in favor of keep redoing those ideas or reusing those ideas. So maybe something like this. You buy a semiconductor stock and you make money with it, so your bias is to keep buying different semiconductor stocks and making money with it. Now this, selection bias is it's a way that basically the mind is limited, so you can't be free of bias all the time. So, if you discover a particular way of making money, you're going to want to keep using that technique or keep it secret, and you're just believing that it's working, but at some point it's not going to work. So this selection bias is a learned bias based on a couple trial and error attempts. You did this, you did that, it worked, okay, keep doing that. But that does not necessarily represent the whole truth. So having an investor having a completely open mind free of biases is impossible. And that's going to skew your purchasing and selling of stocks, which could be detrimental to your later performance. This is why, computerized trading or robo advising, which is a new thing coming up where computers are making the advising and buying and selling the stocks, may be a little bit more effective because they don't have these behavioral biases. Now, if you have a lucky event, so a lucky event issue, which is basically saying, something happened, some investor made this, fantastic performance, so it has these unusually high returns. So the conclusion is, let's do the same thing that investor did, and I'm going to make those unusual returns. But sometimes, you might just get into a stock and get lucky. It just have to be the timing of it, not necessarily matching up with your thought process. So you may have reasons of why you bought something, and I'm buying this company because I like this, or I think this is going to happen, and the stock price goes up, but it might have went up for an unrelated reason to what your investing belief was. But it reinforces that investing belief none the same. And when you try it again, it may not actually work a next time. Okay, so like I was saying before, that the tests on the weak form, the patterns in stock price returns. If we're looking at returns over short horizons, there's a momentum effect. With this momentum effect, basically, if a stock is moving in one direction, it continues to move in that direction as a momentum, sort of like a plane taking off. So stocks that tend to move upward continue to move upward, and stocks that are moving downward as a trend continue to move downward. So there is this trend in the movements that can allow for abnormal performance in certain periods. So returns over a longer horizon, we see sort of a reversal effect where these trends are going to reverse or sort of move more to the mean. So if you had a stock that had basically what it's saying is you might have a stock that just has this higher momentous run and goes from $20 to $200 over a certain period of time. But in the long term, it's going to start coming back down closer to its average. So even though something has a momentum effect for the short term, it usually is going to return back to closer to the mean and reverse that performance over longer periods. So here's a couple predictors of the broad market performance that have been result of some research. One is that the returns in the stock market trend to be higher when dividend yield is lower. And then in 1988, another 1988 earnings yield can predict market returns. So if earnings yields are higher, market returns should be higher. Bond data. So the spread between yields can predict the market returns, and we'll talk a little bit more about that in the bonds chapter. But as far as the semi-strong tests, there are some market anomalies. So there's some things that happen that, let's see the next slide. Okay, here are some of the market anomalies that we're going to talk about. So some things happen that are not explained by the semi-strong form. We don't understand why they happen. So some of the things we can talk about are, patterns that are routinely do occur that are contradictory to the semi-strong form. So one is the PE effect. So if you look at portfolios with low PE stocks, they're going to have higher average returns than portfolios of high PE stocks. So if you made two different portfolios, you put a top 100 highest PE stocks in one portfolio and the bottom 100 lowest PE stocks. And PE is price divided by earnings. So stock price divided by earnings per share. So for example, if a company had a stock price of $100 a share and the earnings are $5 per share, then the multiple would be 20. So it's trading at 20 times earnings. So this is an anomaly showing that stocks with smaller PEs have better returns than stocks with higher PEs. We call it the PE effect. We have also the small firm effect. So stocks of small firms can have abnormal returns, particularly in January. So it's just showing that small firms their stocks outperform larger firms. And I think the way I look at this is that if you had a small company, it's much easier for them to double, triple, quadruple their sales and profits than a big company. It's much harder for a Walmart, a McDonald's to quadruple their sales and profits, but a lot easier for a small, successful new franchise that may only have 20 locations to move that to 40 locations or 100 locations and greatly increase their revenues and profits. So that could be something that is why we have this small firm effect. Neglected firm effect, stock of little known firms can generate abnormal returns. And this is basically saying stocks that don't get much attention, that aren't really talked about in the mass media, may not have an overinflated price. So if you have a stock that is hot and people are talking about it and like their technology and know about it, it may encourage a lot of excess purchasing of the stock, pushing the price up higher. But if you have a stock that's really not well known and it's doing well, at a certain point, there's going to be such a disparity between the stock price and how well they're doing that people are going to notice it, leading to this market anomaly. Book-to-market effects, so shares of high book-to-market firms can generate abnormal returns. So when we say book-to-market, we're looking at the book price, which is the equity per share, compared to the market price or the stock price per share. So if the book value is very high compared to the stock price, this is going to affect returns. Other anomalies here, post earnings announcements. So the price drifts. So a sluggish response to the stock price to firms' earning announcements. That means you can have abnormal returns on announcement day. So this is just basically saying that announcements should already be factored in to the stock price, but we're still seeing that it makes the stock price jump. Also, bubbles and market efficiency. So speculative bubbles can raise prices greatly above intrinsic value, and even if they're inaccurate, you can still take advantage of it. So if the stock market's in the bubble and prices are overvalued, it could go on for another 3 to 5 years. So even though the stock market is overvalued, you still want to be invested in that stock market because it'll be a long time before that market bubble bursts. The trick is to get out before the market bursts. But a lot of investors would say just stay in it for the long term because you can see these routine inflations in the market and contractions, but over a long-term trend, the market is higher in the long term than in the near term. Other market anomalies we can talk about is there's a calendar effect where for some reason stocks returns may be closely tied to the time of year or the time of the week. So certain months or days of the week may provide better investments results than others. And the most famous is the January effect of small businesses, where small businesses seem to greatly outperform or do very well in the month of January. We're not sure why. It's an anomaly. There's also I want to go back to that post earnings drift or momentum. So when we're talking about like how stock prices react to earnings announcements, the result of some studies that track the short-term returns around earnings announcements. So in the study, the stocks reported good earnings exhibiting above abnormal returns. So for the first day or two after the announcement, so these abnormal returns will quickly dissipate. So the stock price jumps and comes back down, or just kind of trails off. So several older studies looked at this tendency for stocks to drift after earnings announcements in the same direction or an initial reaction. So sort of like earnings go up and then they keep drifting higher. So in other words, when companies report better than expected earnings, their stock prices jump immediately, but then surprisingly, these firm stock prices continue to earn positive abnormal returns for weeks or months after the earnings announcement. So the earnings announcement comes up, the stock price goes up immediately, but then continues to drift higher. And stocks that report, negative earnings announcements, generally the earnings go down, but then over time the earnings continue to drift lower. So this is an important anomaly to know about. So that's why when a bad earnings announcement comes out, this sort of makes it worse because people want to get out quickly because they know that the stock can continue to drift lower. And the same thing, what makes the surprise earnings announcements on the higher side make people want to buy the stock and punch it up so much that the next day, because typically the earnings will drift higher. And I guess it makes sense because if a company's doing well, we're going to expect it to keep doing well. And if a company's doing badly, we're going to expect it to keep doing badly, hence the trailing momentum. It might be also that investors don't fully appreciate how bad the news is, so the stock price may take a little bit more time to fully adjust. So sometimes it takes a longer time for the good or bad news to be fully understood and the ramifications moving forward for the stock to be fully understood. So it could take, it can't be fully digested in one day, so it takes a matter of time for the consensus to develop and move the stock price. So this is just an interesting anomaly to sort of talk about. And okay, so here are the average annual returns for 10 size-based portfolios. So let's look at this chart here. We have size decimal 1 being small, 10 being large, and then the annual returns. So in this particular slide or graphic, when we're looking at this, and this is going to be the 10 size-based portfolios from 1926 to 1916. And this is going to, reflect, how would I say, if we're thinking about it, I guess it's going to reflect this small firm effect. So it shows the historical performance of portfolios formed by dividing the New York Stock Exchange stocks into 10 portfolios each year according to the firm's size. So the total value of the outstanding shares of the equity. So the average annual returns between this period, which is, I guess, 90 years, I'm thinking, is consistently higher with the small firm portfolios. So the 1 would represent the smallest firms and 10 would be the largest firms. So we see that this is just sort of the research on the small, the effect of the small stocks over the larger stocks. So there is, if we look at the riskiness, of course the smaller stocks are riskier, but they do have a higher return. So I guess that sort of that capital asset pricing model that we had talked about, improving the stock prices. So let's look at the average annual returns as a function of the book to market ratio that we talked about. And this chart is going to reflect this anomaly. So, here, the stocks with the higher book to market ratios had an average annual return of 17. So that would be 10. So that would be the stocks with the highest. While the lowest ratio would be 10.9%. So this would be the lowest book to market ratio. Down here, stocks with the lowest book to market ratio and stocks here at the highest book to market ratio. So this dramatic dependence on the returns of book to market ratio is independent of the beta that we had talked about. So it suggests that the higher book to market ratio firms are relatively underpriced, and the book to market ratio firms are going to work in the opposite effect. So that means that the book price, when we say book, we mean the book price or the equity price per share. So you took assets minus liabilities divided by outstanding shares, we get the book value per share. And then if we compare it to the stock price, it's basically saying, stocks that are where the book value is closer to the stock value is going to have lower returns than stocks that have a book value further away from the stock value. So that's kind of counterintuitive to how we view how what should happen should not happen like this. So these are why these are anomalies. So okay, so here's another. This is figure 8.5. So what we're looking at here is going to be cumulative abnormal returns that we're looking at here from announcements. So if you look, see the results are somewhat dramatic. So we look at, here's the cumulative average excess return, and this is the days from the earning announcement. So this is the negative days, and then you see how that on the announcement they deviate based on good or bad, and then this is the drift, surprise drift, moving from 1 to 10. Now, so it's dramatic when you look at this chart. So the correlation between ranking by earnings surprise and abnormal returns across, this is expected. So a large abnormal return, a jump in the cumulative abnormal return on the earnings announcements at day 0, and then the abnormal return is positive for positive surprises and negative for negative surprises. So if you look at this, the movement after the earnings date, we see that the positive surprise stocks continue to rise, and the negative surprise stocks continue to move lower. So that's the momentum that we're talking about. So earnings information's become public, and they have a lingering effect in the direction of positive or negative information about the stocks, the earnings of the stock or the news. So we could see that if everything was efficient, we shouldn't see a pattern like this in an efficient market. But again, we see that pattern where these are the negative earnings surprises and the stocks continue to drift lower, and then the positive earnings surprises and the stocks continue to drift higher. So I guess you could earn abnormal returns by simply waiting for earnings announcement and purchasing a portfolio of stocks with positive announcement surprises, and selling or not owning stocks with the negative announcement surprises. So how do we interpret these anomalies? Now, so when we're talking about risk premiums or inefficiencies, we can kind of look at these anomalies, and market phenomena can be explained through the manifestations of risk premiums, as one study has shown, or market phenomena are evident in inefficient markets, as another study may have shown. But clearly the small firms in the market to book and momentum and long-term reversal effects that we talked about in those anomalies are currently among the most puzzling phenomena in the data and in finance. Why do these continue to happen? If the markets should be efficient, why do we continually see this? So this is why we call them anomalies, because they don't conform to the hypothesis that we had made earlier. So we can interpret these effects in different ways. Some of these phenomena could be related. Feature small firms and high book to market firms. We can look at those as, like I said before, small firms naturally are going to have easier time growing than large firms, the ones that do grow, and companies that are undervalued as a relationship to book value to stock price should become more fully valued as that moves forward. So this could be some of the reasons behind these anomalies. And these two studies that I talked about here, they're trying to explain why this occurs and how to interpret them. And it's basically saying that the risk premiums are going to be the cause of this phenomenon, or it's just market inefficiencies. These are evidence of market inefficiencies that are going to become more efficient and level out over time. So we could say market efficiencies, and continuing to interpret these anomalies, market efficiencies, are these anomalies truly we don't know why they happen, or how does data mining affect these? So when we talked about these anomalies, there's even more anomalies than we had talked about. Some of them are even based on who wins the Super Bowl and the weather, and there's a lot of different anomalies that people can put together. So are they just unexplained phenomenon, or is there some factual data that we can learn through data mining? So, after all, if one returns to the databases of the past returns over and over to examine the stock returns among the, all these different dimensions, a simple chance will cause some of the criteria to appear to be happening in predictable patterns. So, but that doesn't necessarily mean they're guaranteed to happen moving forward. So what is the staying power of these anomalies? Some of them are longer term than others, but some of these anomalies, they don't occur every year. They may have occurred in a number of years, but they're not always occurring. So even though there's a percentage of how frequently it happens. Some of them can be 50, 60, 70, even 80 percentile of occurrence, but none of them are 100% going to keep occurring. And returns on style portfolios as a predictor of GDP growth. If we look at this is, I guess, going to be different between different countries. So in this particular chart, I guess we have return to style portfolios predictor of GDP growth. So average differences in the return of the style portfolio in years before good GDP growth versus in years before bad GDP growth. So positive values mean the style portfolio does better in years prior to good economic information, which we say the HML is the high minus low portfolio. Sorted on ratio of book to market value, and the SMB is a small minus big portfolio sorted on size. So it's sort of trying to take those two ideas and put them together. I don't really particularly say this slide is that beneficial or adds a lot of impact or information about what we looked at, but this is just some data they put together for the book. I don't think it's really significant though. Okay, so let's talk about stock market analysis and in context of this. For the most part, analysts are lean more towards being more positive about the market's performance and about companies' performance. So there's been different studies, positive changes associated with 5% increase, negative with 10% decrease. So what does that mean exactly? Let me try to explain. So here's going to be a focus on changes of analyst recommendations, and they find that positive changes were associated with the increase of stock prices, but negative changes were more dramatically associated with price decline. So this would say that if an analyst, since they're already overwhelmingly leaning positively already, so any positive change, the market's going to react with okay. But if it's a negative change, since it's a less of occurrence and a stock opposite of how analysts usually feel, it's going to have much bigger impact on the stock price. So that's why if your stock gets downgraded, generally your stock's going to move down much more than it would have moved up if it was upgraded, is what this is basically saying. So let's move to the next one. Level of consensus is inconsistent predictor of the future performance. So here when they're measuring, and this was done, this study was done I'm not sure when the study was done, but I guess what they're saying here is if everybody's saying the stock is a buy, it hasn't been proven that the stock is a buy. So what I'm basically saying here is they looked at all these recommendations. So they might have had, so let's take the year 2000, you had 21 analysts saying Yahoo stock was a buy. And then within 6 months, the stock lost 80% of its value. So it's been a common occurrence where a lot of analysts borrow from each other or sort of form this little collective group that just sort of feed off each other's analysis. So you wind up getting a lot of positive analyses, and the stock price moves completely in the opposite direction. And I've read reports where people have gone against what the analysts were saying, so invested opposite of the consensus and made stronger returns than investing with the consensus. So it's basically saying that a lot of stock analyst recommendations are useless. And I'm sure they don't like to hear that. So moving on to the third one, firms with the most favorable recommendations outperforms firms with the least favorable recommendations. So here's sort of a consensus, again, another consensus of recommendations. So firms, so if a firms that have the most favorable recommendations are stacked up against the firms with the least favorable recommendations, and this would be the extremes. So in this study, they've noted that this actually you see a difference in performance. But I guess this would make sense if you said analysts to pick the top 100 best stocks in the market and analysts to pick the bottom 100 worst stocks in the market. I guess it makes sense that that these polar opposites should have the stock price moving in that directions. If they're just, think of the worst stocks have to be in firms where the company's businesses are deteriorating or being interrupted by disruption. So there's real no future for those companies. And it's easy for everyone to see, and those prices are going to go down. Where other companies would be technologies or products that are in the upward swing of expansion. So it's easy to say that those companies are going to be doing better. So I guess this kind of makes sense in that analysis. Okay, so when we talk about mutual fund managers, this is an interesting group of people. And we talked about that mutual fund chapter, which is one of the reasons I covered that chapter, because it is connected to a lot of what we're going to talk about in this book. So now, we did talk about this in, say, chapter 4, that professional mutual fund managers have a hard time beating the market. And that's been demonstrated in many studies because it's not much of a study. You just look at what's their performance compared to the market, and oftentimes they can't beat the market. But there is some inconsistent evidence that of a minor persistence in performance, meaning that better managers in one period tend to be better managers in following periods. So there is some kind of consistency in individual people outperforming this overall trend. And I think it's basically saying there are some people who are just lucky or just smarter that do beat the market more often than not, and there's some people who don't. So there's a relative to performance, which could be an interesting thing to look at. So even though in general most funds don't beat the market, there are a few fund managers that are anomalies and do beat the market. Now they also, in this particular thing up here, skilled managers with abnormal performance will attract new funds until additional costs. Complexity drives the alpha to zero. So what this is basically saying is if you're a really wizard, say a Peter Lynch mutual fund manager, who's considered one of the best mutual fund managers of all times, he's since retired, he attracted so much money in his fund that really reduced his fund's ability to keep beating the market, because eventually got to the point where he had to own every stock just to reinvest the funds. So there seems to be some support about the size of the mutual fund itself and the effectiveness of the manager. I believe that one myself. And the last one, on average, bonds, mutual funds outperform passive bond indexes in gross returns, underperform once fees are subtracted. So I guess, if you're looking at bonds, that's going to make sense because a lot of these fees, once they're subtracted, they're going to underperform, even though they can take their bond fund and overperform the market. After you subtract out the fees, you're actually behind the market now. In this study, stock pricing ability of a minority of managers sufficient to cover costs. Performance persists over time. That's more of the same. Records of most managers show no easy strategies for success. Okay, and that's just saying that there's no one formula or strategy a mutual fund manager uses that consistently and continuously successful. So that would say that the mutual fund managers who do continue to be successful are simply just lucky, or they change up their strategy or adapt their strategies. Because if you have a good strategy and everybody starts doing it, it's going to become less effective. So I guess a successful mutual fund manager would be one that continually stays ahead of everybody else by changing up their strategy to keep ahead of the competition. Okay, so in this particular slide, in figure 8.7, here in a study from 2010 from French, the the use of a four-factor model to assess the performance of equity mutual funds and show that while they may exhibit positive alphas before fees, after fees charged to the customers, alphas were negative. So this is, you can kind of see the progression of the alpha based on percentage per month. So that's sort of just a visualization of that research. And then here in figure 8.8, we're going to see, and this is a study that documents performance persistence. So equity funds that rank into 1 to 10 groups by performance in the formation year, the performance of each of these groups in the following years are plotted. And it's clear that except for the best performing top group and the worst performing group, the performance in the future periods is almost independent of the current year returns. So it's saying that, you might have, and this is true for a lot of mutual funds, that there's a saying that, if don't buy the top performing mutual funds from the previous year, because more often than not, they're underperforming in the following year. So it's sort of a reflection of, if you have a bad year as a mutual fund manager, it's going to change. So it may not even be the mutual fund manager's fault. It could just be the segment or the series or the sector he's working on just has a bad year or period. And usually these start to move back to the mean over time. Okay, so the risk-adjusted performance in ranking quarter, and this is figure 8.9. So in this, if we think about, even if the managers are skilled, the alphas will be short-lived. So this would basically see the ranking quarter, then the post-ranking quarter. So even if they do have a successful quarter in this particular slide, it's going to be short-lived. So it's basically just saying that mutual fund managers are not consistently going to have better and consistent returns all the time. It's a very rare thing for a mutual fund manager to completely beat their past performance every year, which makes sense. So in the end, this is our last slide. Are markets efficient? So you've gone over a lot of topics here, and so if we think about, there has to be some efficiency in the marketplace because there is a lot of buying and selling by a lot of active traders. Most of them have an idea of what they're doing, but it doesn't seem that there's enough support one way or another to 100% say the market's efficient or not efficient. And the performance of mutual fund managers is not significant enough to really solidify if the market's efficient or not. And so I guess it's basically saying it's inconclusive. I personally feel myself that the market, is efficient for the information that's available, but due to human emotion, stocks and markets become inefficient due to over or under reactions or trends that occur in bubble phases and in stock market crashes, sort of bull and bear cycles that do overall affect the valuations of stocks. So in general, I think a majority of a stock price is based on factual information, but there's always a segment of that stock price that's going to be affected by greed, speculation, unrelated news, market-related news that's going to affect the stock that has really nothing to do with the fundamentals of the company. So in that case, there is a certain level of market inefficiencies that I've witnessed, but there's also a good portion of the market that's efficient. So I would say, in my own perspective, from my own trading, that stock prices are probably at least 75% efficiently priced and 25% inefficiently priced. That if there is any inefficiency on the upward or downward of the pricing, over priced or underpriced, it typically will move back to the mean of what the pricing should be, as this becomes more evident. And that's sort of why I think technical analysis is helpful to a lot of traders in recognizing when these drifts to the mean are occurring and take advantage of them. And that's why I also believe in fundamental analysis, just understanding the fundamental business and analyzing the change of the performance of the business is usually going to keep occurring in a similar directions. So companies that are doing well generally continue to do well moving forward, and companies that are doing poorly typically tend to continue to do poorly. And it's really an anomaly when that changes, when that direction changes. Okay, so we've given you a lot to think about here. Thank you for your time today, and I look forward to talking to you in the next chapter.